Of course, there is a very strong rally in oil prices. Just to put things in perspective, oil prices for most of the early Feb were trading around $70 a barrel. They shot up to about 80 in the fag end of February. And if you look at just this, just yesterday, oil prices opened at $110 plus, and now they have stabilized to around between 90 to 95. So very sharp $30 movement in just a month. And if you look at intraday volatility, oil prices have been fluctuating for more than 20% in a single day, and that leads to a lot of concern in market participants on how that impacts India, how that impacts the rest of the world, how that impacts the government's fiscal deficit, current account deficit, or RBI monetary policy. So just again, just to give a background on the Iran, US, and Israel conflict, while there is repeated bombing happening in Iran by US and Israel, and there is also some reciprocity by Iran towards US Gulf partners as well as towards Israel, largely what investors are worried about, because Iran is largely shut out from global capital markets or commodity markets. Investors are not really worried about the direct impact of Iran conflict. They are worried about the indirect impact of Iran conflict on global oil and gas supply. So if you look at the map on the right hand side, it shows it shows this Persian Gulf, and if you look at the various Middle Eastern countries which are like UAE, Bahrain, Qatar, Saudi, and on the right hand side Iran, basically about 20% of global oil supply flows through the Strait of Hormuz. 25% of global gas supply flows through the Strait of Hormuz. And the question, of course, naturally is that how can Iran just block it, considering it's a large, area, while theoretically it's 53 kilometers wide, but there's a very narrow navigable channel in this space, and historically Iran has been able to disrupt the day-to-day operations whenever you know uh, there is a geopolitical escalation. And more importantly, what is also happening at this point of time, it's not that Iran as of now is disrupting, but because of the fears of disruption, whether it's shipping companies or insurance companies, right now they are trying to avoid this area because of the fear of significant losses due to these geopolitical, developments, which is leading to a very sharp drop in movement from this area. And again, to give one more perspective, India, China, and South Korea put together receive 70% of their total oil flow, so which passes through Strait of Hormuz. 70% of that oil goes towards India, China, and South Korea. So, of course, these three large Asian economies depend a lot. Of course, till a couple of months back, India was importing more than 30% of its oil requirements from Russia. And as a part of the US India trade deal, as India had stopped importing oil from Russia, the Strait of Hormuz even becomes more critical for India. So, if you look at the table on the right hand side for India, the trade with Iran, whether you look at exports or imports, it's very marginal. It's not even 0.5%. But if you look at the trade with GCC on the bottom side, that's a very significant. That's almost at par with the US. If you look at the imports, it's 122 million exports, 57 million. So that's a very critical part which India, will be looking. So again, if you look at can there are there alternatives to Strait of Hormuz if it remains closed for a while? Yes, so if you see those two pipelines which are mentioned in the map, there is an east-west crude pipeline, and which is operated by Saudi Arabia, and there's a Abu Dhabi crude oil pipeline also, which can export some of the crude, but largely it's about, if you put them together, it's 6.5 million barrels per day. That's still 33% of the transit volume of Strait of Hormuz, where about 20 million barrels per day gets transported. So even if both these pipelines were to operate at full capacity, even then they cannot replace the total transportation done from Strait of Hormuz. And as per most of the expert commentary, if you know there there is continuous attack on energy pipeline by Iran or various Gulf countries, or the Strait of Hormuz remains closed for an extended period, probably oil prices could spike above $120 per barrel as well. Of course, that depends on how how long this conflict lasts and what's the kind of span of this conflict. As of now, market is operating with the expectation that probably at some point of time, the conflict, just like the Russia-Ukraine war, in the first couple of months, there was a lot of volatility, there was a lot of uncertainty, but then the conflict became more regionalized, and whether it's the commodity market or the financial markets, they took it in their stride and they moved on. That's the expectation right now, that probably in a couple of months, um, the conflict may get regionalized or it may subside, and again, commodity flows will go back to normal. And hence we are seeing this drop in crude prices. Also, there were also statements by the U.S. president that probably they are looking to slow down the war, and hence also we are seeing that there is, given the willingness of the U.S., probably market is taking comfort from that also. But of course, things are still uncertain right now, and hence it's the best course of action is to watch out, uh, for investors to see how long this conflict lasts. Just like we saw during Russia-Ukraine, while there was a lot of volatility in the first 2 months, but then the volatility subsided down. So probably it might be slightly rash for investors uh, to exit very prematurely. We would recommend the investors to stay true to their financial goals, to stay true to their investment horizon, and wait for the events to really pan out before taking any premature decision. But how, coming back to India, how it really affects India, if we look at, the statistics, and there have been multiple RBI studies supporting this, broadly a 10% increase in crude oil price, assuming a full pass through, can increase headline inflation by 20 to 45 basis points, depending on the extent of pass through in LPG, pass through petrol, diesel, etc. It typically reduces GDP growth by 15 to 20 basis points and widen current account deficit by 30 basis points. So if you look at the actual crude movement, it's gone from, even if you take the current prices, it's gone from $70 on an average to $90. So that's already a 30% movement in crude oil prices.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.